Welcome, curious minds, to another deep dive.
Great to be back.
Today, we're plunging into a pivotal moment in economic history, the great stock market crash of 1929.
A big one.
Huge. But we're not just dusting off a historical date. Our mission today is to explore a truly timeless pattern.
hmm
Think of it as a recurring cycle of speculative boom and devastating collapse that has echoed through the centuries, right up to the 2008 financial crisis, and some might argue, potentially beyond.
Yeah, the echoes are definitely there.
We're going to unpack a rich stack of sources, from rigorous academic accounts to fascinating contemporary reports, to understand the intricate mechanics of speculative bubbles.
And the forces behind them.
Exactly. The precise forces that allowed the 1929 crash to happen, and crucially, what critical, actionable insights we can draw for you today.
It's about learning from the past, right?
Absolutely. We'll explore how human nature, innovative and often unregulated financial tools, and the critical role of government action, or perhaps more accurately, inaction,
A lot of inaction sometimes.
converge to create one of the most defining economic events in modern history. So let's unpack this together and see what profound lessons the past still holds for us.
What's truly fascinating here, and what our sources really highlight, is how often history doesn't exactly repeat, but it certainly rhymes.
That's a great way to put it.
The narrative of 1929, as we'll delve into, isn't just about abstract economic theory. It's deeply fundamentally human.
Right.
It's about that innate, persistent susceptibility to what our sources call the speculative mood.
The speculative mood.
Yeah, this is a conviction that enterprise, or simply putting your money into the market, can offer unlimited rewards, and that each of us, individually, is not only destined, but quite simply meant to share in those rewards.
Like it's your birthright, almost.
Kind of. And this isn't a new phenomenon that suddenly emerged in the 1920s. It's a timeless one, deeply embedded in our collective psyche, and understanding that is key to understanding the crash itself.
Absolutely. This pervasive idea of a speculative mood is far from unique to the so-called Roaring Twenties.
Not at all.
If you delve back through history, you'll find people, time and again, demonstrating an intense, almost insatiable desire to get rich quickly, with seemingly minimal effort or risk.
The age-old dream.
For instance, consider the infamous Dutch tulip bulb mania in 1637.
Ah, the tulips. Classic.
Where the price of a single exotic tulip bulb could, at its peak, soar to more than the cost of a house. It was a classic example of value becoming completely detached from reality.
Just madness.
Or, fast forward to 1720, ironically, the same year when John Law's pursuit of gold in Louisiana led to a massive speculative frenzy surrounding the Mississippi Company in Paris.
Leaving devastation in its wake.
Widespread financial ruin. And, concurrently, across the English Channel, the notorious South Sea bubble in Britain burst, causing similar devastation for countless investors.
Same year, different bubbles.
Wow. All these were moments where the sheer belief in unlimited rewards, fueled by collective enthusiasm, completely overshadowed any rational assessment of underlying value.
Belief trumping reality.
Yep. And this pattern, as our sources meticulously detail, isn't merely a European phenomenon that stayed across the Atlantic.
Oh no, the U.S. got in on the act too.
The United States, even in its earliest colonial days and certainly throughout its formative years, had its own significant share of speculative splurges.
We saw the earliest colonies experimenting with issues of unbacked currency.
Right, leading to that phrase, not worth a continental.
Exactly. Then, moving into the 19th century, it almost became a tradition, with major speculative booms and subsequent busts occurring almost like clockwork every 20 to 30 years.
Really? That regular?
Pretty much. We observed it vividly in real estate after the War of 1812, with land prices soaring beyond all reason,
Okay.
and again with canals and turnpikes in the 1830s, often fueled by what amounted to unbacked banknotes.
So just paper promises, essentially.
Basically, there's a striking, almost comical example from the 1850s of a New England bank, normally quite conservative, that ultimately closed down with a staggering $500,000 in notes outstanding, yet possessed only $86.48 in actual assets.
$86 for $500,000 in notes. That's insane.
Insane. Think about that for a moment. We also had the railroad boom, which reached a fever pitch before culminating in the painful financial collapse of 1873.
Another bust.
And another dramatic, though less severe, end in 1907. Even British financial giants like Baring Brothers, a pillar of the financial world, were nearly brought down in the 1890s by risky Argentinian loans,
Wow.
only to finally collapse a century later in the 1990s due to what our sources describe as seemingly incredible operations.
History repeating, rhyming again.
Exactly. If we connect this to the bigger picture, you can clearly see how these historical patterns of speculative excess and subsequent correction show up in more recent memory, particularly for you in the context of the 2008 financial crisis.
And what's truly wild and a key insight from our sources is that the Great Crash of 1929 in many ways had a very public dress rehearsal just a few years earlier.
Ah, yes, Florida.
We're talking about the Florida land boom of the mid-1920s. Our sources call it the first indication of the mood of the 20s, a classic example of a speculative bubble built on an indispensable element of fact,
Which was?
which in this case was Florida's genuinely attractive climate and its potential for growth. But this fact was then wildly inflated into what Galbraith vividly describes as a world of speculative make-believe.
Right, taking a kernel of truth and spinning it into fantasy.
People weren't just hopeful. They desperately wanted to believe that the entire peninsula would soon be populated, transforming every last patch of beach, bog, swamp, and common scrubland into incredibly valuable real estate.
This extraordinary phenomenon was fueled, in part, by incredibly easy money and lax lending practices.
Always easy money somewhere.
Land was sold with a mere 10% down payment, a minimal barrier to entry for hopeful speculators. But the real speculative magic and, frankly, the truly innovative aspect of this boom happened with what were called binders.
Binders, what were they?
These were essentially options, the right to buy a piece of land at a specified price within a certain time frame.
Ah, okay. Like futures, almost.
Kinda. You could trade these binders, often for a quick profit, gaining the full benefit of any perceived value increase without actually having to take ownership of the land or pay the full purchase price.
So you're betting on the bet.
Precisely. It was, as our sources aptly put it, speculation, concentrating on speculation, becoming divorced from the underlying asset entirely. The absurdity reached comical, almost unbelievable levels.
Like what?
Charles Ponzi, the notorious con artist of the early 1920s, had a subdivision he marketed as being near Jacksonville, which was actually 65 miles west of the city.
65 miles, that's not near.
Not even close.
Yeah.
And another development, optimistically named Manhattan Estates, was supposedly near the prosperous and fast-growing city of Nettie, a city that simply didn't exist outside the imagination of the promoters.
They just made up a city.
They just made it up. Nettie doesn't exist.
The peak of this madness was truly insane. By autumn of 1925, the sheer volume of traffic flowing into the state, bringing in hopeful investors and construction materials, was so congested that railroads had to impose an embargo on building materials.
Just gridlock. Couldn't even get supplies in.
Prices, already inflated, soared further. Inside, lots near Miami, which might typically trade for $8,000 to $20,000, skyrocketed. Waterfront properties fetched $15,000 to $25,000.
Was big money back then.
And bona fide seashore sites within 40 miles of Miami commanded anywhere from $20,000 to $75,000. It was pure unbridled speculation.
$75,000 for a patch of sand. Wow.
The bubble predictably burst in the spring of 1926 when the crucial supply of new buyers, absolutely essential for fueling ever-rising prices, simply ran out.
The musical chair stopped. No more buyers.
And then, as if a final brutal reminder from nature, two devastating hurricanes in autumn 1926 showed what a soothing tropic wind could do.
Oof, reality bites back.
One, on September 18th, tragically killed 400 people and utterly devastated Miami. Even in the face of such catastrophe, an official like Peter O'Knight, a fervent believer in Florida's future,
Still optimistic.
while acknowledging the desperate need for aid, was actually concerned that Red Cross funds would do more damage permanently to Florida by fostering a culture of dependency rather than promoting self-reliance.
Seriously. Worried about aid after a hurricane wiped out the city.
It just goes to show how deeply embedded the speculative belief was, even in official circles.
What's particularly striking and a vital insight for you to grasp is that despite the widespread knowledge of the Florida collapse and the fact that countless people took quite a beating financially,
You'd think they learned.
the underlying faith of Americans in quick, effortless enrichment simply shifted its focus. It didn't disappear entirely.
It just moved.
It resurfaced with renewed, perhaps even greater vigor in the stock market, where the early signs of a coming speculative spree were becoming clearer by the day.
Ah, the stock market. The next big thing.
Yeah. The core human desire for easy money remained undimmed. It simply found a new, larger arena.
Right. And it's actually hard to pinpoint the exact moment the broader stock market boom of the 1920s truly began, because initially there were indeed sound, rational reasons for stock prices to rise.
Yeah, it wasn't all madness at first.
Corporate earnings were generally good, the economic outlook was largely positive, and stock prices in the early 1920s were quite low, offering what appeared to be favorable yields.
Solid fundamentals, you might say.
We saw a steady, almost modest advance. The New York Times industrial average, for instance, went from 106 in May 1924 to 134 by the end of that year,
Okay, decent growth.
and then jumped to 181 by December 1925. The gains in 1925 were remarkably consistent month after month, reflecting a healthy, growing economy.
But by 1927, the increase began in earnest, taking on an almost relentless character. Day after day, month after month, stock prices went up.
Just steady climbing.
The gains, by the dramatic standards of what was to come, weren't massive on a daily basis, but they were incredibly, almost unnervingly reliable.
Like clockwork.
In fact, in only 2 months of 1927 did the averages fail to show an increase. Even on May 20th, the very day Charles Lindbergh famously took off for Paris on his solo transatlantic flight, the market was still registering one of its small but solid gains.
Wow. Even Lindbergh couldn't distract it.
There was a striking paradox in 1927, too, one that should have given pause. When Henry Ford closed his massive plant to transition production to the new Model A,
Big news, economically.
huge deal. It caused a noticeable dip in the Federal Reserve's Industrial Production Index and led to widespread talk of a looming depression. Yet the stock market remained imperceptible to it, seemingly ignoring the economic headwinds.
Just kept climbing regardless.
It kept climbing.
Yep.
By the end of 1927, the Times Industrials reached 245, a net gain of 69 points for the year. This steady, almost serene advance all happened, crucially, before the truly dramatic speculative surge took hold.
And the seemingly innocuous period, particularly the events of 1927, leads us directly to what many historians and economists have long pointed to as the seeds of disaster, the Federal Reserve's policy action of easing money rates in that year.
The Fed's role, always controversial.
The prevailing doctrine for decades was that this decision, born out of what Galbraith describes as generous but ill-advised internationalism, primarily to help Britain return to the gold standard and stabilize global currencies, directly fueled the ensuing stock market speculation.
Trying to help internationally, but maybe causing problems at home.
That's the argument. Key figures like Montague Norman of the Bank of England, Hjalmar Schacht of the Reichsbank in Germany, and Charles Rist of the Bank of France actually came to the U.S. and actively urged the Federal Reserve to adopt an easy money policy.
So, international pressure.
And the New York Federal Reserve Bank, responding to these pleas, obliged by cutting its rediscount rate. That's the interest rate at which commercial banks can borrow money from the Federal Reserve from 4% to 3.5%.
Making money cheaper to borrow.
The idea was that cheaper money would flow into the markets and stimulate economic activity, which it did, but perhaps not in the way intended.
It's a very compelling narrative, isn't it? Especially because it offers a clean, almost external explanation for the subsequent boom, and seems to, for some, exonerate American behavior by blaming external forces or misjudgments by central bankers.
Yeah, it sort of lets everyone else off the hook.
However, Galbraith, in his trenchant analysis, famously argues that this explanation is formidable nonsense.
Strong words.
He asserts that blaming the Fed's 1927 action fundamentally assumes that people will always speculate if they can simply get access to cheap money.
Which isn't necessarily true.
Exactly. As he meticulously points out, there have been many times before and since 1927-29 when credit was plentiful and cheap, often far cheaper than it was even then, but speculation was negligible, almost non-existent.
So cheap money isn't enough on its own.
He maintains, rather forcefully, that the speculative fervor of the late 1920s was beyond the reach of men who did not want in the least to control it.
Meaning the desire was already there, unstoppable.
That's his take. This really shifts the focus from an external trigger, like a central bank policy, to much deeper internal forces within human psychology and market structure, laying the groundwork for our next discussion about who or what was truly responsible for the runaway train.
Okay.
The core insight here, for you to remember, is that while cheap money can grease the wheels, it's the underlying human inclination to speculate that truly drives the boom, not merely the availability of credit.
So if the Federal Reserve wasn't the sole culprit, and the human speculative mood was already primed, What truly fueled this fire and created the conditions for such an unprecedented boom?
Good question. What kicked it into high gear?
By early 1928, the market's trajectory changed fundamentally. It wasn't just healthy, rational price increases driven by corporate earnings anymore. It was, as our sources detail, a mass escape into make-believe, the true beginning of a speculative orgy.
The fantasy takes over.
Suddenly, the very need for reassurance, the act of inventing new industrial equivalents of the Florida climate to justify ever-rising prices, became astonishingly an actual profession.
People literally paid to blow smoke.
This is where influential figures like John J. Raskob, a prominent director of General Motors and a powerful ally of the DuPonts, enters the picture. In March 1928, on his way to Europe, he publicly suggested that GM stock, then trading around 187, should reasonably sell for 225.
Just throws that number out there.
This wasn't just an opinion, it was a carefully calculated pronouncement from a man whose words carried immense weight.
And, as he might have hoped, the magic of his name did exactly that. His temperate bit of optimism, as the New York Times somewhat ironically labeled it, sent the market into what can only be described as a boiling fury on March 23-24, 1928.
Boiling fury. Wow.
General Motors stock gained nearly 5 points on that Saturday and hit 199 on Monday, setting off a wave of frenzied trading across the entire board.
All from one comment.
Contemporary market observers, like Professor Charles Amos Dice, were almost poetic in their descriptions, noting how these mighty knights of the automobile industry, the steel industry, the radio industry, had caught the vision of progress and sent the market forward, like the phalanxes of Cyrus, parasang upon parasang, and again parasang upon parasang.
That's quite the description, a bit over the top.
Just a bit. It highlights for you how deeply personal influence, perceived genius, and the sheer power of a public endorsement from a celebrated figure could drive this initial accelerating frenzy, overriding any rational assessment of intrinsic value.
Belief again.
This shift from fact-based investment to belief-driven speculation is a key insight into the bubble's formation.
As this speculative mood took hold, two critical indicators began to surge to unprecedented levels: trading volume on the stock exchanges and what were commonly known as brokers' loans.
The fuel for the fire.
These loans were essentially funds borrowed by stockbrokers from banks and other lenders, which were then relent to clients to buy securities on margin, meaning clients only paid a fraction of the stock's price up front, borrowing the rest.
Buying on credit, basically.
These loans served as a direct and immediate measure of the sheer volume and intensity of speculation. Before this period, a 5 million share day on the New York Stock Exchange was considered a wild, almost unimaginable estimate.
Ancient history by 28.
But by March 12, 1928, volume hit 3.8 million shares. On March 27, it jumped to 4.7 million. Then, on June 12, for the very first time in history, it crossed the 5 million share mark with 5,052,790 shares traded.
There it is, the 5 million mark breached.
The ticker, the mechanical device that printed stock quotes, simply couldn't keep up, lagging for nearly 2 hours. A chilling first taste of the technological and logistical chaos that was to come.
The increase in these brokers' loans was even more dramatic and perhaps a more telling sign of the fever pitch.
How much did they grow?
In the early 1920s, they had consistently hovered around $1 billion to $1.5 billion. By early 1926, they reached $2.5 billion, and by the end of 1927, they were at $3.4 billion.
Okay, steady increase.
But the real explosion happened in 1928, reaching $4 billion by June 1st, $5 billion by November 1st, and well along to $6 billion by year-end.
$6 billion. That's a huge jump in 1 year.
This was an unprecedented sum, a massive infusion of borrowed money directly fueling speculative buying. From a lender's perspective, whether banks, corporations, or even wealthy individuals, these loans, particularly what were called call loans,
Meaning they could be called back anytime.
right, on call or on short notice, they were considered among the safest of all investments. Why? Because they were protected by instantly saleable stocks held as collateral and a cash margin from the borrower.
Seems safe, for the lender at least.
And the interest rates on these loans surged dramatically, rising from 5% to 12% in 1928, making them incredibly attractive.
12%, risk-free. Sign me up.
Exactly. New York banks could even borrow funds from the Federal Reserve at its low rediscount rate, say 5%, and then relend that money in the call market at 12%, an arbitrage operation of all time, meaning a virtually risk-free profit derived from exploiting a price difference in two different markets.
Wow, free money for the banks, fueling the bubble.
Pretty much.
So, what you need to understand is that you had people, often with very little capital of their own, essentially paying for the increase in price without the costs of ownership.
Leveraging up like crazy.
And this system of margin buying, fueled by brokers' loans, magnified both the potential gains in a rising market and, as we'll tragically see, the monumental risks when the market turned.
A double-edged sword.
It was a perfect storm for accelerating the boom, making vast sums of money available for pure speculation untethered from underlying economic activity.
And if brokers' loans were the immediate fuel, then the investment trust was arguably the most notable and certainly the most ingenious piece of speculative architecture of the late 20s.
The investment trust, what exactly was that?
This wasn't about promoting new industrial enterprises or enlarging old productive ones. Its true genius lay in creating a mechanism where people could own stock in established, sound old companies through the medium of new ones, the investment trusts themselves.
So like a fund of funds.
Sort of, but with some key differences. This structure brought about an almost complete divorce of the volume of corporate securities outstanding from the volume of corporate assets in existence.
Meaning?
The former, meaning the total value of these newly issued investment trust shares, could be twice, thrice, or even any multiple of the latter, the actual assets they held, effectively creating an almost infinite supply of securities for the public to buy and trade.
Creating paper assets out of thin air, almost.
That's a good way to think about it.
It's incredible to think that this was essentially an old idea used as far back as the 1880s in England and Scotland for pooling small investor funds, spreading risk, and benefiting from expert management.
Yeah, not a brand new concept.
But it arrived comparatively late to the U.S., only gaining traction after 1921. Initially, American promoters were somewhat cautious, but as the 20s wore on, transparency almost completely disappeared.
How so?
Early trusts were structured around specified securities, meaning investors knew exactly what they were buying. But they quickly evolved into investment corporations with broad management discretion.
Meaning they could do whatever they wanted.
Pretty much, allowing them to buy and sell whatever they chose without public disclosure. The New York Stock Exchange actually looked at these trusts with deep suspicion, only listing them in 1929, and even then, requiring a modicum of disclosure of their holdings.
But most avoided the NYSE.
Most simply avoided the big board, preferring the less regulated Curb Exchange or other exchanges, remaining what our sources describe as undertakings the nature of which was never to be revealed to the average investor.
Shady. And their growth was absolutely explosive, a testament to the insatiable appetite for speculative gains.
How explosive?
In 1927, about 160 investment trusts existed, but a staggering 140 were formed in that single year alone.
Wow, almost doubled in a year.
In 1928, 186 more appeared. By early 1929, they were being promoted at the astonishing rate of approximately one new trust per business day,
One a day.
with a total of 265 appearing that year alone. The capital they raised tells an even more dramatic story. In 1927, they sold about $400 million worth of securities to the public. By 1929, that figure had ballooned to an estimated $3 billion,
$3 billion.
representing at least a third of all new capital issues that year. By autumn 1929, the total assets of these investment trusts were estimated to exceed $8 billion, an 11-fold increase since early 1927.
11-fold in 2 years. That's just exponential.
This wasn't just growth, it was a phenomenon of financial edifice rising at a dizzying pace.
And this wasn't just growth for growth's sake. It was immensely, obscenely profitable for the promoters themselves.
Oh, you bet they made money.
Investment banks, commercial banks, brokerage houses, and even other existing investment trusts were sponsoring these new entities. The sponsors, whether from the venerable House of Morgan or smaller, more fiscally perilous firms like Chauncey D. Parker's,
Big names and small-timers alike.
made immense profits by acquiring trust stock at a low price and then selling it to the public at a sizable premium over the offering price. They were essentially printing money by creating new layers of securities.
Exactly. Take Chauncey D. Parker's Seaboard Utilities Shares Corporation as a concrete example of this financial alchemy. He and his colleagues acquired stock in their own trust at just $10.32 a share.
Okay, $10.
Then turned around and sold it to the public for anywhere from $11 to $18.25, splitting the profit with dealers.
So up to an 80% markup instantly. Nice work if you can get it.
That's a tidy profit margin, not exactly small-time operations. Even J.P. Morgan and Company, sponsoring the behemoth United Corporation in January 1929, offered stock packages to their inner circle of friends at $75 a share.
Friends get the inside track.
A mere week later, trading began at $92, $94, quickly rising to $99 within days. Stock acquired at $75 could be, and was, promptly resold for a handsome, virtually guaranteed profit.
Effortless money.
Such agreeable, almost effortless incentives naturally fueled the rampant organization of new investment trusts, creating a self-reinforcing cycle of creation and profit.
Yeah, why wouldn't you start one?
The key insight here, for you, is that the structure of these trusts incentivized their creation more than their long-term performance, leading to an explosion of paper wealth.
So the market was placing a premium, sometimes double, on the securities of these investment trusts compared to the actual underlying value of the assets they ostensibly owned.
Paying more for the wrapper than the candy inside.
This premium wasn't for inert property or productive capacity. It was the value an admiring community placed on professional financial knowledge, skill, and manipulative ability.
Believing in the genius of the managers.
It was the powerful belief that these experts, these financial alchemists, could always somehow increase value regardless of market conditions. To burnish this image and lend an air of intellectual credibility, trusts even hired famous economists like Edwin W. Kemmerer of Princeton or Irving Fisher of Yale to advise on their policies.
Oh, professors get involved.
Giving investors a false sense of security.
It was indeed a golden age for professors lending an aura of scientific rigor to these undertakings. However, the subsequent history suggests that the foresight wasn't quite as perfect as the promoters suggested.
Oh, really? Didn't work out?
The American Founders Group, for instance, which was prominently advised by Professor Kemmerer and Dr. Rufus Tucker, saw its largest company, United Founders, plummet from over $75 share in 1929 to under 75 cents by 1935.
75 cents from $75. Ouch.
Despite all that money expert advice. Even more damning, Paul C. Cabot, himself an organizer of a promising investment trust, actually warned in a March 1929 Atlantic Monthly article about the rampant dishonesty, inattention, inability, and greed pervading the industry.
Someone saw it coming.
But his stark warnings were largely ignored, dismissed, due to what he later described as very poor audience response. People simply didn't want to hear anything that might spoil the party.
Nobody wants to hear bad news when they're making money.
This really speaks to the power of collective delusion during a bubble.
And this brings us to the truly magical, yet incredibly perilous element of the investment trusts, the mechanism that turned modest gains into explosive, almost unbelievable returns. Leverage.
Leverage, the magic word.
It's like the game of crack the whip. A modest movement at the origin creates a major whipping jolt at the far end. Investment trusts achieved this by issuing different classes of securities, bonds, preferred stock, and common stock,
Layering the capital structure.
all to purchase portfolios of common stocks in other companies. The genius, from a speculative standpoint, was that when the underlying common stocks rose in value, which was always optimistically assumed,
Always assumed they'd go up.
the value of the bonds and preferred stock issued by the trust remained largely unaffected, as they had fixed claims. This meant that most of the gain from the appreciating portfolio was concentrated entirely on the trust's common stock, causing it to rise marvelously, often far outstripping the gains of the underlying assets.
The math here, for you to truly grasp the scale of this, is staggering. Imagine an investment trust capitalized at $150 million, equally split between bonds, preferred stock, and common stock, so $50 million for each.
Okay, equal thirds.
If its underlying portfolio of common stocks appreciated by a modest 50% to $225 million.
Which sounds great, 50% gain.
The bonds and preferred stock would still be worth their original $100 million.
Yeah.
But the common stock, initially worth $50 million, would now be backed by $125 million in assets.
Whoa, wait, so the common stock value jumped from 50 to 125.
Exactly. A phenomenal 150% increase in value for the common stock on a mere 50% rise in the underlying assets.
That's incredible leverage.
And here's where it gets even crazier. If that leveraged common stock was then held by another leveraged trust, and that trust's common stock by another,
Oh, God. Layers upon layers.
the original 50% gain could translate to a mind-boggling 700% or even 800% gain for the common stock at the next layer of the pyramid.
Just 700%.
This geometric series struck Wall Street with the force of a new, revolutionary invention, leading to a frenzy of trusts sponsoring trusts that sponsored more trusts. Harrison Williams, for instance, built a vast $1 billion financial system from an initial $6 million company in 1921 purely through this pyramiding.
$1 billion from $6 million. Just Wow.
The American Founders Group went from a mere $500 in initial capital in 1922 to over $1 billion in assets across 13 companies by 1929, largely thanks to $320 million in intercompany holdings that enabled this control and leverage.
Building empires on paper.
Essentially.
But, and this is the absolutely critical insight you must take away as it was later to develop, leverage works both ways.
The catch.
And that, of course, is the inherent peril that was still unrevealed during the speculative ascent. It promised dizzying heights on the way up, but ensured a catastrophic fall on the way down.
Speaking of revelations, the pinnacle of this gargantuan insanity in New Era finance, as our sources describe it, was arguably Goldman Sachs and Company.
Goldman Sachs, a big name even then.
Despite being a relative latecomer to investment trusts, only launching the Goldman Sachs Trading Corporation in December 1928, its growth was explosive and set new records for financial audacity.
Oh, so?
Initially, it had no direct leverage in its structure. Goldman Sachs itself bought 1 million shares at $100 and then sold 90% to the public at $104.
Modest start.
Relatively.
But the value increase of the Goldman Sachs Trading Corporation stock was absolutely astonishing. By February 2nd, 1929, stock originally sold at $104 was trading at $136.50.
I had pop in a few months.
Just 5 days later, on February 7, it soared to $222.50.
Doubled in 5 days.
A value approximately double the actual current worth of its underlying assets. This wasn't just public enthusiasm. Goldman Sachs Trading Corporation itself was actively engaged in self-dealing, buying 560,724 shares of its own stock for over $57 million, essentially boosting its own value through circular transactions.
Buying their own stock to prop up the price? That sounds problematic. It was a closed loop of self-generated demand. And then came the audacious pyramiding, taking leverage to new heights. In July 1929, Goldman Sachs sponsored the Shenandoah Corporation with $100 million in capital.
Okay, another layer.
This was followed by the even mightier Blue Ridge Corporation with $142 million in capital in August. And crucially, Blue Ridge was sponsored by Shenandoah.
So Shenandoah owned Blue Ridge, and Goldman owned Shenandoah. The pyramid grows.
Exactly. Blue Ridge even innovatively allowed investors to exchange routine, solid securities like AT&T or General Electric for its own stock, further broadening its reach and enticing new money into the pyramid.
Making it easy to join the party.
In less than a single month, in the summer of 1929, Goldman Sachs issued over $250 million worth of securities through these new trusts.
$250 million in a month.
It was a frantic, almost desperate pace of new trust formations and issues, a true testament to the peak of this speculative illusion, and, as you can clearly see, an unsustainable model. The core insight here is how seemingly legitimate financial innovation can, when unchecked and driven by pure profit motive, create ever larger, more fragile structures.
So by the summer of 1929, that traditional summer lull in market activity was nowhere to be found.
No rest for the speculators.
Prices and speculation volume rose at an appalling rate month after month. The market wasn't just a financial tool or a topic of discussion. It literally dominated the culture.
Everyone was talking stocks.
In June, the Times Industrials shot up a staggering 52 points. In July, another 25, and in August, an additional 33 points.
Just relentless gains.
That's a total of 110 points in just 3 months, from 339 on May 30th to 449 on August 31st, representing a nearly quarter overall increase in stock values. This wasn't just gains, it was a societal obsession.
Individual stocks, of course, saw spectacular, almost unbelievable gains too, becoming household names that everyone talked about. Westinghouse was up 135 points.
Wow.
General Electric 123, U.S. Steel a solid 93, and even a normally somber, stable stock like AT&T gained 94 points.
Even the steady ones were flying.
Meanwhile, the lifeblood of this speculative buying, brokers' loans, continued to increase at an alarming rate of $400 million a month.
Still pouring fuel on the fire.
Exceeding $7 billion by summer's end. And crucially, more than half of this money came not just from banks, but from corporations and wealthy individuals, all chasing those incredibly high interest rates, often 7, 12%, sometimes even a dizzying 15% on their loan funds.
So companies were lending money to the market instead of investing in their own businesses.
Many were. Why build a factory when you can get 12% risk-free in the call market? This wasn't just about big finance. It was everyday people and companies putting their excess money directly into the market, chasing those irresistible, seemingly effortless returns.
What's truly striking, and a crucial insight into the psychology of a bubble, is that despite these obvious, almost grotesque excesses, the soaring prices, the exploding brokers' loans, the flimsy investment trusts,
You'd think someone would sound the alarm.
sound and responsible spokesmen decried not the increase in brokers' loans, but those who insisted on attaching significance to this trend. Pessimism, even cautious realism, was practically treason in this environment.
Shoot the messenger.
Charles E. Mitchell, the powerful chairman of National City Bank, was repeatedly angered by any attention given to the ominous rise in brokers' loans, dismissing concerns. The Wall Street Journal even published a complaint, rhetorically asking, "Why is it that any ignoramus can talk about Wall Street?" implying that only those truly immersed in the market's euphoria understood its soundness.
Only the insiders get it right. Classic bubble talk. Indeed, even academic scholars played into this narrative. Professor Charles Amos Dice of Ohio State University, despite his academic credentials, concluded that high brokers' loans were not to be greatly feared.
Even the professors.
The Midland Bank of Cleveland stated, with what now seems like chilling certainty, that there were no real cause for concern until loans reached a massive $12 billion.
Setting the bar incredibly high for danger.
Then, of course, you had the official optimists, the true prophets of the new era. Bernard Baruch, a prominent financier, famously told the American magazine that the economic condition of the world seems on the verge of a great forward movement.
Great timing, Bernard.
Lawrence of Princeton confidently believes stocks are not at present overvalued, a statement that aged terribly. And perhaps the most famous of all, Irving Fisher of Yale,
Fisher.
delivered his now infamous permanently high plateau estimate, asserting that stock prices had reached a stable, sustainable level.
Permanently high plateau, those words haunt him.
Even the Harvard Economic Society, after initially being mildly bearish, reversed its stance and continued issuing wildly optimistic forecasts. Incredibly, even after the crash had begun.
After the crash, they were still optimistic.
Yes, this illustrates for you the profound human tendency for cognitive bias, where uncomfortable truths are dismissed in favor of comforting narratives.
But there were skeptics, voices of reason desperately trying to cut through the euphoria, though they were largely ignored.
Always a few Cassandras.
Paul M. Warburg of the International Acceptance Bank, a respected financial figure, for example, warned as early as March 1929 of a disastrous collapse if unrestrained speculation wasn't halted, directly predicting it would bring about a general depression.
He nailed it. What happened to him?
Yet he was largely dismissed by the establishment as obsolete, a relic of an old era, or accused of sandbagging American prosperity simply by speaking inconvenient truths.
So they attacked him instead of listening.
It speaks volumes about the collective desire to believe and the powerful societal pressure to maintain optimism, even when faced with stark warnings.
And that desire, as our sources show, permeated everything. The market's dominance wasn't confined to the financial pages of the boardrooms. It became a central topic of conversation, a shared aspiration that infused daily life.
Your barber giving you stock tips.
Exactly. Literate brokers transformed into oracles, sought after for their pronouncements.
Yeah.
Women, too, entered the market in increasing numbers, seeing it not just as an investment vehicle, but as man's most exciting capitalistic game, believing that success there would significantly elevate their prestige and standing.
Everyone wanted in on the game.
People didn't speak of U.S. Steel as a company with factories and workers, but rather as symbols on a tape and lines on a chart and a price that went up.
Detached from the actual business.
There was a pervasive failure to know what isn't known, where people eagerly absorbed information without critically understanding its true basis or implications.
It truly became a full-time activity for many, mimicking the almost frantic intensity of the South Sea Bubble era, where, as one observer noted, statesmen forgot their politics, lawyers the bar, merchants their traffic, even the women themselves their pride and vanity.
Life revolved around the ticker tape.
Brokerage offices were perpetually packed with customers glued to the blackboard, desperate for the latest quote, the newest rumor, the slightest hint of inside information. This illustrates how a speculative bubble can completely consume a society, drawing in every segment.
And much of this intense fascination was tragically tied to the pervasive belief that the market was less and less a long-run register of corporate prospects and more a product of manipulative artifice.
People thought it was rigged.
Widely believed, yes. Pool and syndicate operations were rampant and widely known. Our sources indicate that over 100 issues on the New York Stock Exchange were manipulated in 1929 alone.
100 stocks manipulated.
Traders would pool their resources, Appoint managers to boom a particular stock through active, often artificial, buying and selling, stimulating interest via tip sheets and rumors.
Pumping and dumping.
The public's reaction to this wasn't to condemn it as unethical or illegal, but rather to eagerly seek out that same inside information to profit alongside these great men like Cutton, Livermore, Raskob.
So instead of outrage, it was, how can I get in on it?
Exactly. It was a market where knowledge of the game or perceived inside access, not the underlying value of a company, was seen as the true key to success. The core insight here is that when speculation reaches a fever pitch, the fundamental purpose of the market to value companies gets completely lost to the game of making quick money.
Labor Day, September 2, 1929, though unassuming at the time, marked the unofficial end of the Great Bull Market.
The beginning of the end.
Frederick Lewis Allen, a contemporary observer, describes September 3rd as a quiet, tranquil day, seemingly far removed from the gathering storm on Wall Street. Headlines were dominated by the Graf Zeppelin's round-the-world flight, a tragic plane crash in New Mexico, Babe Ruth's latest home runs, and the success of Eric Maria Remarque's anti-war novel, All Quiet on the Western Front.
Life goes on, seemingly.
But beneath this calm facade, on September 5th, the first significant crack appeared, the immediate trigger. Roger Babson, the well-known educator, philosopher, and statistician.
Babson, the party pooper.
Who at a business conference delivered a dire, almost prophetic prediction. A crash is coming, and it may be terrific.
Didn't mince words.
He chillingly suggested that Florida's recent real estate fate would soon come to Wall Street, predicting a Dow Jones drop of 80 points and warning that factories will shut down, men will be thrown out of work.
The market reacted immediately, as you might expect from such a prominent warning. The Times Industrials dropped a noticeable 10 points that day, and trading volume mounted as people, spooked by the prediction, sought to unload their shares.
The Babson break, they called it.
That's right. Wall Street naturally reacted with a mixture of scorn and denial, swiftly denouncing Babson. Barron's, a leading financial publication, ironically called him the Sage of Wellesley and dismissed his notorious inaccuracy.
Attacking the messenger again.
Irving Fisher, still publicly confident in his permanently high plateau, countered with a firm declaration that there was no anything in the nature of a crash. A Boston investment trust even issued a calming, albeit somewhat desperate message to its clients. STEADY, everybody.
Steady as she goes down.
While the market rallied temporarily in the days that followed, the underlying trend, viewed in retrospect, had decisively shifted. It was slightly erratically, but quite definitely down.
The peak was over.
New trusts continued to be formed, and brokers' loans continued to rise, indicating that while the end had come, it was not yet in sight for many, and the illusion persisted.
Despite these clear, if subtle, signs of weakness following the Babson break, elements of the ingrained New Era faith, that unshakable belief in endless prosperity, persisted stubbornly through October.
Denial is a powerful force.
The Saturday Evening Post, a widely read publication, featured Ivar Kruger, the Swedish Match King, as an engineer ruling through pure reason, a symbol of the new rational age. Andrew Mellon's announcement of staying in the cabinet, even as Treasury Secretary, was widely seen as a confidence booster, a sign of stability.
Trying to project calm.
Charlie Mitchell, the perpetually optimistic chairman of National City Bank, continued his relentless reassurances, declaring the U.S. absolutely sound and emphatically stating that nothing can arrest the upward movement. He insisted even later that markets generally are now in a healthy condition.
Still banging the drum.
Irving Fisher, perhaps in his most famous misstep, even delivered his final, confident, permanently high plateau speech on October 15th, a mere 2 weeks before the bottom fell out.
Oh, Irving.
Oh.
Terrible timing. But the reality on the ground was becoming increasingly grim, despite the official pronouncements. October 19th, a Saturday, saw a very weak market, with heavy declines across the board, and the Times Industrials plummeting 12 points, blue chips seriously off.
Starting to get ugly.
This was significant enough to make Sunday's front-page news across the country. Then came Monday, October 21st, a very poor day, with over 6 million shares traded, an astronomical volume for the time.
6 million.
Huge selling pressure. Crucially, the ticker, the system printing stock prices, lagged by an agonizing hour and 40 minutes, causing immense fear and uncertainty.
Not knowing the real prices, pure terror.
Many, for the first time, began to realize, with terrifying clarity, that they could be ruined totally and forever and not even know it, because they couldn't get real-time price updates. Fisher, era the optimist, attempted to calm nerves by calling the decline a mere shaking out of the lunatic fringe, crediting prohibition for worker productivity, a truly bizarre connection.
Prohibition, what did that have to do with anything?
Who knows? Mitchell reiterated his fundamentally sound argument, insisting the market would correct itself. However, a stark contrast came from Roger Babson, who simply and consistently recommended selling stocks and buying gold.
Babson stuck to his guns.
The stage was now irrevocably set for chaos.
And chaos is precisely what arrived on Black Thursday, October 24th, 1929. This was the first day that history truly identifies with widespread panic, characterized by sheer disorder, fright, and confusion on the trading floor.
Black Thursday, the first domino.
A staggering 12,894,650 shares were traded, a new, terrifying record. But as our sources describe, often there were no buyers. Prices plummeted vertically, creating huge air holes in the market, meaning there were no bids at all at certain price points, causing stocks to fall precipitously without trading.
Just falling into nothingness. At noon, with the market in free fall, the cavalry seemingly arrived. A high-stakes meeting was urgently convened at the venerable J.P. Morgan & Company,
The big guns assemble.
bringing together the nation's most powerful financiers. Thomas W. Lamont from Morgan's, Charles E. Mitchell from National City Bank, Albert H. Wiggin from Chase National Bank, William C. Potter from Guaranty Trust, and Seward Prosser from Bankers Trust. The mere news of their meeting seemed to have an immediate calming effect, appearing to stabilize prices momentarily.
Just the news helped.
For a moment. Then, in a truly dramatic moment, Richard Whitney, the debonair vice president of the NYSE and Morgan's actual floor trader, dramatically strode onto the trading floor.
Whitney makes his entrance.
In an act totally devoid of normal commercial reticence, meaning an unusual, very public display of confidence, he loudly bid $205 for 10,000 shares of U.S. Steel, precisely the last sale price, even though current bids were visibly lower.
A very public statement purchase.
He then proceeded to place similar, large orders for 15 to 20 other blue-chip stocks. It was a visible, orchestrated show of support designed to restore confidence and prevent total collapse.
In addition to the banker's intervention, business leaders across the country, from Eugene Stevens of Continental Illinois and Chicago to Walter Teagle of Standard Oil and Charles M. Schwab in steel, all rushed to declare that fundamentals are sound.
The fundamentals are sound chorus.
Even President Herbert Hoover joined in the chorus, asserting that the fundamental business of the country is on a sound and prosperous basis. There was, however, one notable dissonant note. Governor Franklin D. Roosevelt, speaking in Poughkeepsie, criticized the fever of speculation, a comment that foreshadowed future political battles.
FDR sensing the mood shift.
But for the moment, the organized support from the financial establishment seemed to hold, providing a brief, fragile reprieve.
Unlike previous market slumps, however, this time the worst continued to worsen. There was no lasting recovery. The reprieve was fleeting.
The bounce didn't stick.
On Monday, October 28th, there was no sign of Richard Whitney on the trading floor making dramatic bids, and the market resumed its relentless slide. Charles E. Mitchell was observed entering Morgan's, and U.S. Steel did rally briefly, but Whitney's powerful, visible presence from Black Thursday was absent.
Where was Whitney?
And Mitchell himself was likely focused on securing a personal loan to cover his own market losses, not orchestrating a rescue. The bankers met again that evening, and their public statement after the session revealed a profound, almost resigned philosophical shift.
What did they say?
Their purpose, they stated, was not to maintain any particular level of prices or to protect anyone's profit, but merely to ensure an orderly market and prevent further air holes.
Basically, we can't stop the bleeding, just try to keep it tidy.
That's the gist. This was the quiet, almost implicit end of any hope for sustained, organized support. Their prestige, which had been so high just days before, began to fall rapidly as the market defied their efforts.
And it all led to the most devastating day. Black Tuesday, October 29th, 1929, was arguably the most devastating day in the history of the New York stock market, and it may have been the most devastating day in the history of markets globally.
Black Tuesday. Even worse than Thursday.
Selling began immediately and in massive volume, reaching an astounding 33,000 a day rate in just the first half hour. The air holes blew wide open. There were no buyers at all for many issues, meaning prices simply evaporated.
Total panic selling, no bids anywhere.
For example, white sewing machine stock, which had been trading at 48 just months before, closed at 11 the night before and was then bid for a mere $1 a share on Black Tuesday.
$1. from 48.
The ticker, overwhelmed, lagged by 2.5 hours at the close, preventing anyone from truly knowing their financial fate until much later. A staggering 16,410,030 shares were recorded as traded.
16 million shares. More than 3 times the number that was once considered a fabulously big day. The Times Industrials plummeted 43 points, wiping out all gains of the preceding 12 months in a single brutal day.
A year's gains gone in hours.
The investment trusts, once seen as sources of boundless leveraged gain, now saw leverage working in reverse with catastrophic efficiency.
The downside of leverage hits hard.
Blue Ridge, for example, which had traded at 24 in early September, dropped from 10 to a mere 3 in a single day. Most trusts' stock became virtually unsaleable, plunging to near worthless.
Wiped out. It was a cruel application of Gresham's law, which states that bad money drives out good. In this context, the pressure to sell meant that even good, fundamentally sound securities held by these trusts were dumped onto the market to meet margin calls, further depressing the entire market.
Selling good stocks to cover losses on bad ones.
Trusts even engaged in what our sources describe as fiscal self-immolation, desperately using their dwindling cash to try and support their own collapsing stock.
Throwing good money after bad. A maneuver that only 6 months prior had been seen as brilliant financial engineering, but now accelerated their demise. Goldman Sachs Trading Corporation's investment in Shenandoah, for instance, led to Shenandoah's collapse, hitting Goldman Sachs directly. As Galbraith starkly observes, men succeeded on a large scale in swindling themselves.
The physical and mental toll on Wall Street was immense. Brokerage staff and exchange employees worked through the night, often fainting from sheer exhaustion, trying to process the deluge of trades.
Just utter chaos and exhaustion. And the bankers, whose intervention had briefly stemmed the tide on Black Thursday, were now thoroughly discredited. A devastating rumor swept the exchange that the bankers' pool was actually selling stocks rather than buying them to support the market.
Selling. The ultimate betrayal.
While Thomas Lamont vehemently denied it, it was later revealed that Albert H. Wiggin, the formidable head of Chase National Bank, was personally short to the time of some millions, meaning he had bet on the market going down.
Wiggin was shorting the market while supposedly supporting it,
creating what our sources call an interesting element of ambivalence in his cooperative support of the market. It shows the deep conflicts of interest at play.
Unbelievable.
This Black Tuesday marked the complete and utter failure of any pretense of organized support and the absolute capitulation of the market to an impersonal, uncontrollable force of panic selling. The market had finally reached its breaking point. For you, the key insight here is that when a speculative bubble bursts, even the most powerful figures and institutions can be overwhelmed, and their self-serving actions can exacerbate the very crisis they claim to be solving.
After the devastating Black Tuesday, there was a miraculous recovery on Wednesday, October 30.
A dead cat bounce.
Seems like it. The Times Industrials were up 31 points, recouping a large part of the previous day's brutal losses. This brief rally was largely attributed to what our sources call organized reassurance from government officials like Julius Klein, a key advisor to President Hoover, and prominent businessmen like Waddell Ketchings.
More fundamentals or sound talk.
As well as intentionally positive dividend news from industrial giants like U.S. Steel and American Can. And in a symbolic gesture of confidence, the venerable John D. Rockefeller even issued a statement about buying sound common stocks.
Rockefeller steps in. A sign of confidence.
Following this, the exchange closed for a few days for holidays, providing a much-needed pause. In a stark and critically late reversal, the Federal Reserve lowered its rediscount rate, that rate at which banks borrow from the Fed, from 6% to 5% and launched open market purchases to ease money rates.
Fed finally acts. A bit late, maybe.
A move designed to encourage lending and liquidity. However, it was largely too little, too late.
However, this brief respite was exactly that, short-lived. After a substantial but ultimately false recovery in January-March 1930, the market resumed its relentless drop, ultimately hitting its absolute low point on July 8, 1932.
So the crash wasn't just October 29, it went on for years.
For years. The Times Industrials, which had closed at 224 on November 13, 1929, after the initial crash, plunged all the way to 58.
58, from a peak of what, 450?
Yeah. Around there, yes. The losses were truly staggering for individual companies. U.S. Steel fell from 262 to a mere 22, General Motors from 73 to 8, and Montgomery Ward, a household name, from 138 to a shockingly low 4.
Just decimated.
The losses were absolute and catastrophic, far beyond the initial crash, revealing the true fragility of the underlying economy.
One persistent myth that arose from this period, especially fueled by the sensationalist London press, was the dramatic image of financiers leaping from windows, a symbol of ruin and despair.
Ah, the suicide myth.
However, our sources clarify that the popular image of a suicide wave directly following the crash was largely a legend of 1929.
So not as common as portrayed.
While suicide rates were already gradually rising pre-1929 and continued to increase that year, a much sharper increase in suicides actually occurred in 1930, 1931, and 1932.
So it's more linked to the Depression itself.
This indicates that the rise in suicides was linked more directly to the broader, prolonged economic depression and the pervasive unemployment, not just the market's initial fall. The psychological toll of joblessness and poverty was far greater than that of stock market losses for many.
Indeed. The case of J.J. Riordan, a prominent bank president and associate of Al Smith, highlights the intense efforts to manage public panic. He tragically shot himself on a Friday, but the news was deliberately and meticulously withheld by authorities until Saturday noon.
Why wait?
After the banks had already closed for the weekend, precisely to prevent a run on his institution.
Damage control.
As the astute Walter Bagehot famously observed, every great crisis reveals the excessive speculations of many houses which no one before suspected. The crash and the subsequent deepening of the Great Depression truly exposed the excessive speculations of many houses which no one before suspected, causing a convulsive shrinkage of reputations across the financial world. The veil of respectability was ripped away.
And among those whose reputations were spectacularly dimmed were the scholarly forecasters, the very academics who were supposed to provide objective analysis.
The professors didn't look so smart after all.
Irving Fisher, despite his brilliance in other economic fields, made wildly optimistic predictions, including his now infamous, permanently high plateau estimate. What's astonishing is that even after the crash, he attempted to explain it away as a mere shaking out of the lunatic fringe, or mob psychology, but his efforts were largely dismissed as self-serving and out of touch with reality.
Trying to save face, maybe.
The Harvard Economic Society, too, which had initially adopted a mildly bearish stance pre-crash, then inexplicably reversed course and continued to issue wildly optimistic forecasts for recovery even into 1930 and 1931.
Doubling down on being wrong.
Their reputation for infallibility was utterly dimmed, and the society itself eventually dissolved, a casualty of its own failed predictions.
The bankers, who had for so long enjoyed an almost unassailable prestige, also saw their reputations collapse even faster and more dramatically than the market itself.
The mighty fall.
Albert H. Wiggin, the formidable and imperious head of Chase National Bank, was a prime example. While receiving a princely $275,000 as Chase head and holding directorships in an astonishing 59 other companies.
59 companies.
His most breathtaking operations, as our sources describe them, were in Chase stock itself, incredibly financed by the bank's own funds.
Using the bank's money to play his own stock?
Between September 23 and November 4, 1929, his private company, Shermar Corp., engaged in significant short selling. That is, selling borrowed stock in anticipation of a price decline of over 42,500 shares of Chase stock.
He was shorting his own bank during the crash.
This allowed him to profit over $4 million as prices fell. When questioned, he defended bank loans to officers for speculation, but struggled to justify his personal short selling against his own bank stock.
Yeah, that looks pretty bad.
Upon his retirement, he was initially voted a life salary of $100,000, a gesture he himself initiated. But later, amidst a scathing Senate investigation that exposed his vast and often self-serving enterprises, he was forced to renounce it.
Public pressure forced his hand.
Definitely.
Charles E. Mitchell, the prophet of the new era and the genial, extroverted chairman of National City Bank, suffered an even more public and spectacular fall.
Mitchell, too.
Mitchell's compensation was staggering. Over $1.3 million in 1928 and $1.1 million in the first half of 1929 alone. He attempted to support National City stock during a merger, purchasing shares, but failed as the price plummeted.
Lost big time.
Then, in a move that drew public outrage to wipe out his substantial 1929 tax liability, he sold 18,300 shares of stock to his wife for a reported $2.8 million loss.
Sold it to his wife. for tax reasons.
only to reacquire them later at the same price when their actual market value was much lower. This thinly disguised tax purposes transaction, frankly admitted during a humiliating Senate hearing, led to his indictment for tax evasion.
Indicted for tax evasion.
Wow.
Though he was acquitted in the criminal case, he later lost a civil claim for the taxes owed, embodying for many the money changer figure that President Franklin Roosevelt had vowed to drive from the temple of finance.
Became a symbol of Wall Street greed. But for many Americans, and certainly for the public image of Wall Street's excesses, the ultimate symbolic evil figure was Richard Whitney.
Whitney again, the guy who tried to stop the panic on Black Thursday.
The very same. He was the former acting president of the NYSE, its staunch defender, and came from impeccable Wall Street stock, his brother being a partner at J.P. Morgan. Whitney's own firm, Richard Whitney and Company, had expanded into various losing businesses, from mineral colloids to peat humus and even Applejack distillation in New Jersey,
Applejack, really?
accumulating millions in debt. He tried desperately to support his failing Distilled Liquors Corporation stock, buying up almost all outstanding shares as the price plummeted from $15 to $3 to $4 a share. Galbraith vividly described him as the Ponzi of financial self-deception, relentlessly throwing good money after bad.
Yes, he utterly exhausted his vast capacity to borrow, eventually resorting to outright larceny.
Larceny. Like theft.
He posted client securities and even the stock exchange's own gratuity fund securities as collateral for his personal loans, a practice he had engaged in for several years.
Stealing from clients and the exchange itself.
In March 1938, he was dramatically arrested by Thomas E. Dewey, then the aggressive district attorney of New York, for grand larceny. His disinterested dignity in admitting guilt and refusing a defense only cemented his symbolic role in the public consciousness.
Went down with dignity, sort of.
His default, though smaller in scale compared to the financial devastation caused by others, was joyously received by Wall Street's antagonists precisely because his identity was wholly with the stock exchange, the symbolic center of sin for many.
The perfect scapegoat.
His spectacular fall, therefore, tragically cleared the way for significant reforms that would otherwise have faced insurmountable politically charged resistance.
And those reforms were indeed significant, directly addressing the systemic failures revealed by the crash and the subsequent misconduct.
What kind of reforms?
The Securities Act of 1933 and, more comprehensively, the Securities Exchange Act of 1934 brought sweeping, revolutionary changes. They required full disclosure for all new issues of securities, outlawed deceitful inside operations, and short selling by insiders to profit from falling prices.
Targeting guys like Wiegand.
Exactly. And crucially, gave the Federal Reserve Board the unprecedented power to fix margin requirements, even up to 100%, effectively eliminating margin trading entirely if deemed necessary to curb speculation.
Taking away the cheap credit fuel.
Pool operations, where groups of traders artificially inflated stock prices, along with wash sales, simultaneously buying and selling to create a false sense of activity and the dissemination of false information, were all explicitly prohibited.
Cleaning up the manipulative practices, a truly key reform born directly from the conflict of interest demonstrated by people like Mitchell and Wiegand, was the forceful divorce of commercial banks from their securities affiliates, preventing them from engaging in risky investment banking activities.
The Glass-Steagall Act, essentially.
Precisely. Most importantly, the foundational principle was firmly established that stock exchanges, once largely self-regulated private clubs, were now subject to public regulation, and the powerful Securities and Exchange Commission, the SEC, was created to enforce these new comprehensive rules.
The SEC is born from the ashes.
The Whitney affair itself, coming years later, symbolically marked a turning point. When the NYSE leadership, including its president Charles R. Gay, traveled to Washington to report Whitney's suspension to the SEC, it symbolized what our sources call the surrender of the exchange, effectively ending the Cold War over regulation and ushering in a new, much-needed era of government oversight and investor protection.
A huge shift in power. This is a crucial insight. Major crises often catalyze necessary but previously resisted systemic change.
Okay, so the crash was bad, the aftermath revealed huge problems, and reforms followed. But what about the link between the crash and the Great Depression itself?
Right. The crash of 1929 was without question a cataclysmic event. It was a terrifying punctuation mark in economic history. But it was also, crucially, followed by something even more devastating and prolonged: the Great Depression.
10 long years.
Which afflicted the United States, with varying severity, for a full decade, truly until 1940. In 1933, at the Depression's low point, the gross national product was nearly a third less than in 1929, and unemployment peaked at nearly 13 million people.
1 in 4 unemployed. Unimaginable.
Meaning 1 in every 4 in the entire labor force was out of work. The stock market collapse was undoubtedly a powerful catalyst, yes, but the economy was, as Galbraith meticulously noted, fundamentally unsound beforehand, making it uniquely susceptible to such a profound and prolonged downturn.
So the crash lit the fuse, but the powder keg was already there.
That's a perfect analogy. It was not merely the crash that caused the depression, but existing fragilities that the crash brutally exposed.
And it's a crucial distinction for you to remember that the broader economy had actually begun to weaken even before Black Thursday.
Things were slowing down already.
Federal Reserve indexes of industrial activity and factory production, which were our most comprehensive monthly measures of economic health at the time, actually peaked in June 1929 and were already declining through the summer,
Before the panic hit Wall Street.
suggesting an inventory recession, a period where businesses produce more goods than consumers are buying, was already subtly underway. The stock market collapse then didn't create the economic weakness. It brutally exposed and accelerated 5 major, deep-seated underlying weaknesses that were already present in the U.S. economy of 1929,
Okay, what were these 5 weaknesses?
acting like a giant, destructive magnifying glass.
First, and perhaps most fundamentally, was the bad distribution of income.
Too much money at the top.
The rich in 1929 were, as our sources put it, indubitably rich. The top 5% of the population received approximately 1/3 of all personal income in the country.
A third of all income for just 5%. Wow.
And income, derived from interest, dividends, and rent, was double the level seen in the post-World War II era. This meant that the economy relied heavily on what economists call discretionary spending, that is, volatile luxury spending, and significant investment by the wealthy.
So when the rich got hit, the whole economy felt it disproportionately.
Exactly. When the crash hit, it disproportionately impacted this vital group, leading to a sudden, sharp contraction in both their spending and their investment, causing a broader economic contraction that rippled through the entire system.
Okay, weakness number 1, income inequality. What's 2?
Second, and directly related to our earlier discussion, was a bad corporate structure.
The investment trusts and holding companies?
Precisely. The vast new structure of holding companies and investment trusts that we detailed earlier created inherent instability, a house of cards ready to fall, because these pyramids relied on dividends from operating companies at the bottom to pay interest on bonds issued by holding companies higher up.
The leverage effect again?
Any interruption of those dividends, which the crash triggered, led to cascading defaults, bankruptcies, and the swift collapse of entire corporate pyramids. This forced a massive curtailment of investment and borrowing across the economy, accentuating an already dangerous deflationary spiral,
Making the downturn much worse.
where prices and wages fall, leading to less spending and further economic contraction.
Bad income distribution, bad corporate structure. Number 3.
Third, and perhaps most critically for the average American, was a fundamentally bad banking structure.
Banks failing everywhere.
In 1929, many banks were small, lacking federal supervision, and crucially, were not diversified across regions or industries. This made them incredibly prone to failure.
Lots of small, weak banks.
But the truly devastating weakness was the complete absence of federal deposit insurance.
No FDIC back then.
None. When fear struck, as it inevitably did after the crash and into the Depression, bank failures caused widespread panic, leading to runs on other, still solvent banks as people rushed to withdraw their life savings.
Panic begets more panic.
This led to further cascading bank failures, which in turn caused a catastrophic contraction of credit, leaving businesses unable to borrow and consumers unable to spend, further depressing purchasing power across the economy. Okay, bad banks. What's number 4? Fourth, there was a bad foreign balance.
International trade issues.
The United States in 1929 was a significant creditor nation, meaning other countries owed it money, and it was accumulating gold reserves. However, a crucial part of this dynamic involved foreign loans, particularly to countries like Germany and those in Central and South America.
Lending money abroad.
These loans, as our sources expose, were often tied to corruption and unsustainable practices. For example, in a truly egregious case, the son of Peru's president was reportedly paid $450,000 for simply not blocking a $50 million loan deal.
Corruption greasing the wheels.
When U.S. foreign lending abruptly stopped after the crash, these foreign countries, unable to access credit, no longer had the funds to purchase U.S. goods. This caused a severe drying up of foreign purchases and had a devastating impact on American exports, exacerbating domestic economic woes.
So the international connections broke down too?
Completely.
That's four. What's the fifth weakness?
And finally, a truly profound weakness was the poor state of economic intelligence and prevailing dogma.
Bad ideas, basically.
The dominant economic thinking of the era severely hindered any effective government response. Both major political parties were committed, almost religiously, to a balanced budget, even advocating for severe spending cuts and tax increases in the face of a rapidly deepening economic crisis.
Cutting spending during a downturn, that sounds wrong now.
We know better now, but back then, this, in a deflationary environment, only worsened the downturn by further contracting demand. It was a rigid formula, a straitjacket on policy.
Couldn't adapt.
Similarly, despite massive deflation where prices were plummeting, the entrenched fear of going off the gold standard and triggering runaway price increases, inflation limited almost all monetary policy options.
Afraid of inflation during deflation.
Bizarre, right? Devaluation of the dollar, a potential tool, was flatly ruled out. This amounted to a near-total rejection of all affirmative government economic policy, a triumph of dogma over thought that left policymakers paralyzed and unable to react effectively to the unfolding catastrophe.
In light of these five deep-seated systemic weaknesses, the stock market collapse served as an exceptionally effective way of exploiting them.
Like hitting all the weak points at once.
It directly and immediately hit the spending and investment of the wealthy, and because of the corporate structure, this swiftly translated into declining orders and increasing unemployment across the entire economy. The most disconcerting feature, as our sources conclude, was that given the prevailing rigid economic ideas of the time, nothing could be done about the deepening crisis,
Just watch it happen.
leading to a profound, almost paralyzing sense of hopelessness for policymakers and the public alike.
So what does this all mean for us now, for you, sitting here today, a century later, while many, many people vowed never again after 1929?
You hear that phrase a lot after crises.
The American people, as Galbraith points out, remains susceptible to the speculative mood. A rising market and easy opportunity will always tempt participation. The government now has vastly more sophisticated preventatives and controls ready, mechanisms like the SEC, margin requirements, and deposit insurance.
The tools exist now.
And their efficacy in the hands of a determined government cannot be doubted. But, and this is the absolutely critical caveat, there are 100 reasons why a government will determine not to use them.
Politics gets in the way.
Political considerations, such as avoiding unemployment at an inopportune moment before an election, make timely action incredibly difficult. Booms, after all, are only stopped after they've started, and the person who pricks the bubble inevitably becomes the executioner in the public eye, bearing the blame for the downturn.
Nobody wants to be that guy.
Nobody.
However, our economy has indeed been profoundly strengthened since 1929, directly addressing many of those five weaknesses.
We did learn some things.
Income distribution, while still an issue, is less lopsided. The top 5% of the population's share of total personal income dropped significantly from a third to less than a fifth. The massive, unstable investment trust pyramids, like Goldman Sachs Trading Corp, largely folded up and were replaced by more regulated, albeit sometimes still complex, financial instruments.
Those crazy pyramids are mostly gone.
The SEC and new bankruptcy laws effectively flattened out utility holding companies, preventing new layers of unstable leverage. And critically, federal insurance of bank deposits, introduced in 1933, was a revolution, fundamentally curing the failure begot failure dynamic of bank runs.
FDIC made a huge difference.
Foreign balance issues have also changed significantly, with the U.S. now typically buying more than it sells, altering the international financial dynamic. And perhaps most importantly, there's been a modest accretion of economic knowledge.
We got slightly smarter, maybe?
So that at least we now understand not to liquidate labor, liquidate stocks, liquidate the farmers, liquidate real estate as a prescription for dealing with a depression.
We don't try to bleed the patient anymore, hopefully. Yet despite these significant reinforcements and the accumulated knowledge, Galbraith warned that it would be unwise to expose the economy to the shock of another major speculative collapse.
Still vulnerable?
Fissures could still open in unexpected places, and even the rapid withdrawal of spending from inflated market gains could be damaging. There remains a profound, almost frustrating inverse correlation between financial capacity and political perspicacity.
Meaning the powerful aren't always wise, and the wise aren't always powerful.
That's a good summary. What this means is that those with the most financial power often lack the foresight or political will to act against short-term gains, and those with political power find it difficult to act against popular sentiment. Wall Street's self-preservation instinct, while present, is often overridden by the lure of short-term convenience and immediate profit.
Short-term thinking wins out.
As our sources conclude, inaction will be advocated in the present, even though it means deep trouble in the future. This is precisely what causes men who know that things are going quite wrong, who see the danger signals, to publicly insist that things are fundamentally sound.
Back to the fundamentals or sound line again.
The human element of self-deception and collective delusion remains, perhaps, the most dangerous and enduring weakness.
Understanding the intricate dance of human psychology, financial innovation, and government response in 1929 offers us profound, perhaps uncomfortable but undeniably relevant lessons, even today.
Absolutely relevant. While history doesn't repeat exactly, the patterns of human behavior and market dynamics certainly echo through the decades.
Which leads to a final thought.
This raises an incredibly important question for us and for you, the listener. Considering the powerful insights gleaned from this deep dive into 1929, what might be the modern equivalents of the moral suasion and the no business meetings?
Those subtle ways of not acting.
Exactly. Those subtle, unspoken, or even overt forms of inaction rooted in political expediency or collective optimism that still prevent us from taking bold, difficult actions when we see the speculative mood returning today, even with all our accumulated knowledge and regulatory tools.
Are we doomed to repeat the same mistakes, just in different forms?
How do we ensure that next time we don't just talk about the lessons of history, but truly decisively act on them?
A powerful thought to ponder indeed. Thank you for joining us on this enlightening and hopefully truly insightful deep dive.
Always a pleasure.
We'll be back soon with another exploration into the heart of what makes our world tick. Until then, keep asking questions and stay curious.